Today I want to talk to you guys about adjustable rate mortgages, also known as ARMs. Before we jump into the topic today, guys, subscribe to the channel, turn bells on for notifications, drop us a comment. We really appreciate your support. Make sure to stay tuned to the end of the video for the pro tip of the day. Now, we're going to want to talk to you about 4 things. Why ARMs today are not the product of the past, what kind of adjustable rate mortgages are out there and what the different terms mean, 7-1, 5-1, 10-1, 2-1, when they might be good for a potential buyer, a good option, and when they might not be. So first of all, let's talk about ARMs today compared to ARMs of the past. So after the last mortgage meltdown, ARMs became a 4-letter word in our industry because they became synonymous with people who were unable to afford a fixed rate. And so they got into these exotic adjustable rate products, and then the payment would adjust, it would spike upwards, they were no longer able to afford the payment, they got foreclosed on, and it contributed to the crisis, right? So that's the idea people have in their head when they say, oh, ARMs are coming back, that means, you know, it's a terrible idea. When the Dodd-Frank Act was passed in 2010, it made sweeping changes to the mortgage and real estate landscape, and one thing it did is it created new rules around what lenders could do with adjustable rate mortgages. One of the most important things is it put caps on how much it could adjust in any given period and how much it could adjust historically. The ARM products, the adjusting rates, are safer today than they were in the past. Also, they are qualifying borrowers based on the highest potential interest rate, not the initial loan payment like they did back in the day. So there are protections in place which make ARMs less risky today than they were in the past. So now let's talk about the different types of ARM products there are. There are 2-1 ARMs, 5-1 ARMs, 7-1 ARMs, 10-1 ARMs. So a 2-1 ARM is when there's an introductory rate. Let's say rates today are 5.5%. So in year 1, the rate will be 3.5, fixed at 3.5. In year 2, it'll be 4.5, and then in years 28 to 30, it'll be 5.5 and never change from there. So that is essentially a 30-year fixed product with 2 adjustments at the very beginning. So that might be a good product for someone who knows they have more income coming in the future, if they're going to get a raise, maybe if they're about to get married or bring on a roommate or something in the future that would allow them to make that payment comfortably as the rate adjusts upwards. And then if you know you can make the payment at 5.5%, then those first 2 years are just an opportunity for you to save money. And then when you get into, year 3 and you're at the, now fixed rate for the rest of the time, if you can comfortably make that payment, then you know you're in good shape. It's not adjusting every 6 months and jumping 6 or 7% at a time, which was possible with the products in the past. A 5-1 ARM is an adjustable rate mortgage that's fixed for 5 years and then adjusts every year after that. 5-6 ARM would be fixed for 5 years and then adjustable every 6 months. And then there's a 7-1 ARM, similar story, 7 years fixed and then adjust once a year, and 10 years the same. I'm sure there's a bunch of products out there that I'm not mentioning and a bunch of pieces of it. So get with your lending professional. We don't do lending here. This is just a basic structure of what these products are. You hear adjustable rate mortgages, but they are actually fixed for a period of time. So if you have a 10-1 ARM, that product is going to be a fixed rate for 10 years. Most people aren't in their home for 10 years or in the loan for 10 years. These adjustable rate mortgages are fixed for a period of time. Not only that, but they have adjustment caps. There's going to be a loan officer that hops in here and corrects me, but the way I understand it is this, is that on a 2-1-5 structure cap, the rate cannot go up or down more than 2% in any given year, and it cannot adjust more than 5% above the initial loan. So if you get into an adjustable rate mortgage today at 4.5, at no point, it can't go up more than 2% in any given year, and it can't go up more than 5% on top of your initial loan. The point is there are structures to these things that keep them from getting out of hand, even when you get into your adjustable period. So when might this product make sense for somebody? So I've discussed this in other videos. If you are one of our military members and you know that you're retiring in the next 10 years or less, and hey, the minute I retire, I'm getting the heck out of San Diego, a 10-1 ARM might be a good idea because there's no sense in getting a higher interest rate to do a 30-year fix at a higher rate. If you know you're going to be gone in 8 years because you're retiring from the military, then it would make sense to get a lower rate, do a 10-1 ARM because it's fixed for that 10 years. You sell the house in 8 years when you're retiring and you've had a lower interest rate the entire time. Now, when might this not be a good idea? This might not be a good idea for someone whose income is a little more sporadic or who is using it on a shorter term and going to need to be in the home longer. If you don't expect your income income to increase with the potential of the increasing rates. You know that you can get in at 4.5% today and afford it, but that your job is changing to the negative. Maybe you're retiring and going to be on a fixed income in 5 years. So I would never recommend an adjustable rate mortgage for someone who's going to be in the home longer than the fixed rate period and not making more money, making less money, or retiring, their roommate is leaving, or one of these cases. Times when this makes sense, there are times when it clearly doesn't, and the fact of the matter is the adjustable rate mortgage products today are not the same as the adjustable rate mortgage products in the past. They do carry some element of risk, but they are also structured in a way that eliminates some of the risk that they carried in the past. So guys, the life pro tip of the day is this. The real estate pro tip of the day is this. Every situation is different. Every situation is unique. All else equal, an adjustable rate mortgage and a 30-year fix, if those rates and pricings were exactly the same, then you do the 30-year fix all day long so you never have to think about it. But the fact of the matter is, if you have some certainty that you're only going to be in these properties or in these loans for a certain period of time, the fixed part of the adjustable rate, it could make sense depending on your unique situation. So make sure you get with your lender, with your finance people, and with your real estate agent to structure a deal that works best for you. So that'll be it for me today, guys. I appreciate you watching. Subscribe to the video, turn bells on, like and comment. We really appreciate your support as always, and we'll talk to you soon.